Hello everyone. So in today's video, we'll be discussing the recent case of BlackRock Holdco 5 LLC versus HMRC. This has been pronounced on 11th April 2024. The Court of Appeal, UK Court of Appeal, discussed about the principal purpose test around the interest payments on intra-group loans which were put into place as part of the funding structure for a commercial acquisition. It was noted in this decision that the decision of the court was not only restricted by transfer pricing rules, but also applicability of unallowable purpose rule was extensively discussed. And finally, the decision was taken on the basis of the unallowable purpose rule. So let us see what this case is all about. So a brief background of the case: in 2009, BlackRock acquired Barclays Global Investors, BGI for short, for roughly $13.5 billion. The acquisition structure involved BlackRock Financial Management as the Delaware parent company and the formation of 3 entities which were incorporated in Delaware as limited liability companies as follows. One was BlackRock Holdco 4, which is referred to as LLC 4 in the subsequent slides. Then there was an LLC 5 as well as an LLC 6. Now, the acquisition, it involved intra-group loans amounting to $4 billion, which were issued from LLC 4 to LLC 5. LLC 5, which is a UK tax resident, was entitled to deduct interest on the loans in its corporate tax returns, transfer the losses to other UK group entities, and also reduce its, as a result, reduce its overall tax liability. So that is why the whole issue arose. Now the key issues in the appeal, they involved BlackRock's financial structure in acquiring BGI US, especially the UK tax deductibility of interest on $4 billion intra-group loans for the acquisition. HMRC, it disputed LLC 5's deduction claim on 2 main grounds. So firstly, it said that no loans would have been made between independent parties acting at arm's length. So the tax deduction should be denied under the transfer pricing rules in Part 4 of the Taxation Act 2010. So essentially, it questioned the commercial rationality of the whole structure within the transfer pricing domain. Second point or second ground of the issue raised by HMRC was that it further relied on unallowable purpose rule in section 441 of the CTA. The unallowable purpose rule is engaged where the unallowable purpose condition is met. That is, at times during an accounting period, the company is party to the loan relationship or enters into a related transaction in respect of the loan relationship for purposes which include a purpose which is not amongst the business or other commercial purposes of the company. So to put it simply, the main purpose of the transaction would be tax avoidance. So this is what unallowable purpose rule says. Then such a transaction will be unallowed or disallowed. Now, the UK Court of Appeal, it ruled against BlackRock. It upheld HMRC's position that certain interest expenses were not deductible. So essentially the court, it allowed LLC 5's appeal on the transfer pricing issue. So there were two grounds, if you remember, which were raised by HMRC. First was the commercial rationality, the transfer pricing ground that independent enterprises would not enter into similar transaction. However, the court allowed LLC 5's appeal on the transfer pricing issue, with the result that deductions for interest on loans should not be restricted. However, on the second ground, the court agreed with HMRC that the loan was structured primarily. So the principal purpose of this loan transaction was for tax advantages. So as the UK entity involved had no significant commercial function apart from facilitating this tax benefit. So on the unallowable purpose issue, the interest relief should be denied because securing a tax advantage was the only purpose of the relevant loans. Therefore, the court finally upheld the HMRC's stance on the basis of the unallowable purpose rule, and the deductions for interest on loans was disallowed. Now, the key takeaways of this decision are essentially that it clarifies the application of the unallowable purpose rule for tax deductions. This case serves as a critical reminder for the importance of aligning the tax planning strategies with legitimate business activities. The main emphasis here was on the fact that the structuring led to tax advantage, which was the primary purpose. Hence, the disallowance was made by the court as well. So while undertaking structuring, the unallowable purpose rule have to be taken into consideration when a UK entity is involved. So this is an important decision, I would say, in the transfer pricing as well as international tax space for all the viewers who are doing LLM International Tax, Advanced Diploma in International Tax, Diploma in International Tax provided by ICAI. They all can refer to this judgment for knowledge enhancement. Even professionals in the corporate structuring may find the details of this case particularly valuable for navigating their operations within the UK's regulatory framework. Thank you so much for watching the video. If you like the content, please do let me know by way of comments what more you would like to hear from me, and I would be happy to make videos on that. Thank you.